Monday morning here, and we've got some news coming through in terms of mortgage financing. And today we're joined by Joe Jacobs with Mortgage Connections. Good to have you, Joe.
Thanks for having me.
Pleasure, pleasure. Well, we like to have a source on board that can fully or get a thorough explanation as to what's going on here. So on Friday, we weren't able to connect, but CMHC, I wouldn't say they launched a bomb, but basically a bit of a disruptor in terms of lending coming out in July there. So just when you thought it was getting easier and more affordable to own a house in Calgary and Alberta, and building wealth through real estate, tell us a little bit about what CMHC unveiled last week, starting in July 1, and how we might be able to get ahead of the curve here.
Sure. So CMHC basically came out saying that they were going to revise their underwriting guidelines for any insured mortgage. So in general, that means anyone that's buying a house with less than 20% down. So definitely impacting first-time buyers, but certainly also impacting move-up buyers and everyone in the market to a certain degree. The rationale for this is that they are concerned on risk with everything that's happened with COVID. They're concerned on potential default, higher leveraged Canadians taking on more debt. So they're using that maybe as a bit of a reasoning behind it, but we'll talk first, I guess, on what the changes are, and they're significant. So I'll start with the first one that I think is probably having the least impact on borrowers, and that is removing what's called the flex down program. So what that is that borrowers are able to borrow a down payment from like a unsecured line of credit or something like that and use that for their 5%. It's not a huge market that is doing that, but that is being eliminated. So they're basically saying you need to have your own 5%, or it can come from a gift for family, but it can't come from a borrowed resource. So that's the first change that's happening. The second one, which is certainly more significant, is credit. And so there is a concern from CMHC's perspective anyway about the credit worthiness of a borrower. And so they are moving the minimum credit score from a 600 minimum beacon score up to a 680 for at least one borrower. So that's a pretty significant jump, especially because the credit systems have all changed in the last little while. So your credit is more important than ever to make sure that it's well maintained, because one missed payment could bring your score down below that level. And if you're a single buyer or buying with someone, and both of you are below that 680, you wouldn't qualify for CMHC's insurance now. So that's a significant one. And then the third change, which I actually think is the biggest one and is going to have the most impact on buyers for the most part, is a reduction to what they call their debt ratio. So in general right now, you can use 39% of your income to go towards your housing costs. So that's for your mortgage, for utilities figure they use, and property taxes. And then 44% of your income can go towards that, plus any outside debts you may have. So that would be car payments, loans, that sort of thing. They're making a reduction of that, taking it from 39.44 to 35.42. So dropping it by basically 4% on the house side, and then an additional 2% on the outside debt. So what that all means for people is just simply that they're going to qualify for less. So what they could buy today after these rule changes will be a less amount.
So if they're buying something for, I don't know if you can give an arbitrary number, but say right now their current purchasing power, they could qualify up to $550,000. How much of a substantial, or how big a discount is that going to be moving forward July 1?
Yeah, I think that's the important thing that's kind of missed here. When you just throw out 35 versus 39, it doesn't sound that big, but from a buying power standpoint, it actually is. So it's somewhere, and it depends on the borrower and the income, but it's somewhere between about 9 and 13% reduction in buying power. So if you're talking about someone that qualifies at 500, they're now down to 450. So it could take them out of the house or the market that they thought they were in. The other part of that is frustrating for me when you think of they're trying to, the government's always basically saying they're trying to help, young Canadians or someone getting into home ownership. These changes disproportionately impact people that have a lower income already and are already looking at buying a less expensive property. So it's impacting someone that's maybe buying that 300,000 and that's their top level more than someone who's buying the 500. So definitely, if you have someone that's at that lower qualifying amount, this change is even a bigger impact, and it could take them right out of the market and force them into rent.
Yeah, or yeah, I mean, you don't want to be living somewhere that you don't really find desirable, so to speak, right? Or the spacing just doesn't work. Why do you think that they didn't look at adjusting the down payment, say from moving it from 5% to 10%?
I mean, there was certainly some talk on that. A few weeks ago, President Evan Siddell of CMHC came out when he did his address, and one thing that at least the media picked up was talk on changing down payment. Realistically, I don't think that was ever actually on the table, and what they were maybe trying to do is throw that out as it could have been worse. We were talking about doing this, and instead we're just changing it to some more prudent underwriting, in their opinion, anyway. I think going from 5 to 10% change in down payment is it'd be a pretty tough thing to justify when you've you're already seeing the housing market slow in a lot of the major centers that they're concerned about, and that would kind of definitely cause that to happen. So kind of joke a little bit that the reality is, from a housing standpoint, especially in the really hot markets like Toronto and Vancouver, the housing market's already pregnant. So you can't just decide now that you want to totally change things and think everything will be fine. You're impacting new buyers that are probably hoping that they now have an opportunity to get into the market. They've saved up a down payment. They're seeing some price reductions happen, and all of a sudden you're just going to take that away from them. So I don't think they wanted that approach, and I don't think it would have been something that the government would have wanted to deal with, the outlash of that. But so I think it was a bit of a play to say we're going to do changes, and we could have done this, but instead we're just tightening these little areas here.
Yeah, no, that's interesting. So why do you think CMHC, has kind of pushed this on board? I mean, we're definitely not wanting to, curtail, the housing industry. It's definitely a big, stimulus in any economy. Why do you think that they've gone ahead and done this?
Your guess is as good as mine. It's not something that personally I agree with. I think that this is the worst possible time for them to be concerned about things like this, when the economy is obviously in a tough spot. The housing market being robust is a huge part of the Canadian economy staying on track, or at least not going off the rails completely. So there's not a real justification that I can explain, for the simple fact that defaults are not super high. There was a lot of concern that they were saying, 12% of lenders' books are in deferral right now, and they're concerned that once those expire, defaults will increase. So at the end of the day, CMHC is an insurance company, so they're concerned about their payouts. They're concerned about claims that come against them. So they're trying to de-risk it, and obviously it's less risky if people have higher credit ratings, and it should be less risky if they're borrowing smaller amounts. So that's justifiable, but the timing doesn't make a ton of sense. And we just don't really have default issues in Canada right now. Even from the deferral side, although they're accurate in, about 12% of books with most lenders went into deferral payment, most of them that I've talked to, most of the big lenders, they haven't had an increase since kind of the initial outcry. So they don't have people coming now asking for deferral. And a lot of the book that did has actually already gone back to lenders saying, actually, things aren't as bad as I thought they were. I'd rather not be on deferral and get my mortgage back in order. So I think it's a reactionary step on kind of worst case scenarios, and seeing seeing things go a way they wouldn't want them to go, but I don't know if there's a real justification based on what's actually happening.
Yeah, it's one of those things where yesterday's news is now no news, because I think it was the mid-May that Bank of Canada come out and they were talking about the defaults increasing exponentially towards the end of the year. So that's good news. I think that's really good news. So we've been kind of chatting about CMHC and what they're launching coming July 1. What about the other insurers like your Genworth is Genworth following along the same lines there?
Yeah, so there's 3 insurers in Canada. CMHC is the government crown corporation, but then there's also Genworth Financial and Canada Guarantee. So those are private insurers, and normally they follow CMHC. It's if someone makes a move, they all make a move. What's interesting is on Friday, both Canada Guarantee and Genworth kind of indicated that they weren't necessarily going to follow suit on this, and they didn't necessarily agree with CMHC's stance. We haven't heard from Canada Guarantee as of yet, but just this morning there is actually a release from Genworth, and they have at this point said that they are not following suit with CMHC, and that they are very comfortable with their risk of their book and their tolerance and their underwriting guidelines as is. So we've got a really unique situation now where you actually will have Genworth potentially doing insurance on applications and borrowers that CMHC will not. I think Genworth is probably going to be picky on those. They're not necessarily going to take everyone that's at the absolute, max, but they're going to very quickly kind of probably pick business that they think's solid, strong, and do it. So that's a positive because it's going to allow consumers that are maybe now just over where CMHC rules have put them still in a position where they can, qualify for the house they want. So we'll see what Canada Guarantee says, but it was pretty bad news. Like I know you said it wasn't a bomb, but in our world, we thought it was a pretty big bomb on Friday. So to know that at least one of the private insurers is not following suit is really positive. And the insurers are the same to any borrower. So that's important to know too. Like everyone says CMHC just because they're the one that's best known, but your costs, your premiums, everything's identical with all the insurers. So it's not a negative where you're being forced to an insurer that's not equally as strong as CMHC for a borrower.
Come July 1 then, is a buyer, do they have the ability or should it just almost be a default that, as a mortgage broker, you're going to submit a file to Genworth or Canada Housing before you would to CMHC? I hope I'm asking that question correctly. I mean, to me, it would seem like a no-brainer to, write the file and, put the alternative insurer on there as opposed to CMHC if, somebody's looking at purchasing a house for $550, if they're looking for that property versus being forced into sub 500. Is that something that you'll do, or is it more of a case by case?
Yeah, so ultimately the lending institutions decide where what insurer a file is going to, but they're certainly going to adjust their model where I don't see the lending market following suit with CMHC. A lot of them were blindsided. They weren't even in discussions with CMHC before this announcement happened. So they're very comfortable with the underwriting as it is right now. So you're going to see definitely a big shift, I think, to the other insurers, especially if Canada Guarantee follows Genworth's lead. CMHC will still get a huge amount of business because it's important to realize not everyone is at these limits anyway. And that's part of the reason why I think the changes are quite interesting. It's not as if every person that's getting an insured mortgage is at their limit. Most people aren't. So, but you will see a shift there for sure. I guess the thing that's going to be important on our end is to just make sure that borrowers know and buyers know kind of where their limits are. We could have issues where an insurer says, yeah, we'll go to that limit, but we're not comfortable with these properties. So it's going to be a moving thing. Like there's certain condo developments that an insurer may not do. So if that's what you want to buy, you might not have an option if the only insurer that's doing it is CMHC and you're at a limit that they won't approve.
Mhm. Yeah, no, that's a really good point. Okay, so to sort of maybe navigate some muddy waters there, I've had a couple clients ask me, like if I get pre-approved um, before July 1, does that negate if I was to have a offer be purchasing, say, July 10th or August 10th? Maybe you can explain, yes, that's the same, or there is a difference. And
Yeah, no, it's a very good question. So unfortunately, pre-approvals do not count for this. So the CMHC kind of guideline is that the borrower or buyer has to have entered into a contract before July 1. So if they've got an accepted purchase agreement before July 1, old rules will apply. If it's day after, they're under the new rules. I guess the only positive to this is that I think we're going to have a little more wiggle room because we have two other insurers that are hopefully not going to fall CMHC's lead. But I guess my big thing for anyone that is pre-approved is you've got to review your numbers with your mortgage broker or whoever you're dealing with right now, just to make sure that they're still what you think they are, or at least that you understand that they may not be, your buying power may be reduced if you don't meet the requirement, or even worse, if you don't have the credit requirement, you may not even be able to qualify under a CMHC insured mortgage anyway. But again, the good news is the fact that at least Genworth is saying we're not following it. That's a bit of a sigh of relief on our end, that we don't have, a bunch of clients that are out shopping that suddenly need to totally change what they're looking for. So it's a little better than we were thinking going into the weekend for sure.
yeah. Well, let's maybe touch on some good news about lending rates right now, and maybe put a bit of a spin on this. What's happening with rates in terms of variable and fixed, and what do we see over the next 6 months here potentially? No crystal balls.
Yeah, yeah, definitely no crystal balls, because the rate market's done a lot of crazy stuff in the last few months. But the positive is we're seeing kind of record low rates happen again. So five-year fixed money has done a bit of a aggressive fall in the last couple weeks. So you're back to kind of record low, like full feature products under 2.3%. And variable rates, we're starting to see bigger discounts come back into the market. So when the Bank of Canada slashed rates aggressively in March and April, what lenders ended up doing was removing the big discounts they had off variable and adjustable rate mortgages. But we're starting to see them trickle back in. So what went to just a variable rate at prime, you're starting to see discounts get closer to that 0.5% off prime. We're not there yet, and we're certainly not at the prime -1s we were at the beginning of 2020. But it's all positive in that regard, is that you are seeing rates come down. So, cost of borrowing is going down, and, there's certainly an opportunity, I think, for buyers now where they've got good opportunity to buy a house price that's maybe down a little bit, and their cost of ownership certainly down with the mortgages right now. So that is positive, and the only thing that was negative, hopefully, is being adjusted a little bit with the other insurers not following suit.
Right. And then what does the qualifying rate come down to under 5%? What's it sitting at right now?
Yeah, so that has also come down, not a huge amount, but it was at 5.04, the stress test qualifying rate, and it's now at 4.94. So that was boosting up buying power a bit. So, that's still the case. It's not a huge jump, but it's about 3 to 4% increase on buying power from where you were. So again, cheaper rates, a little more buying power, as long as the insurers don't change everything, which it looks like they're not going to. So yeah, you're in a good position that way.
All right. So the push is on over, I guess, for the next 3 weeks here, to try and educate our buyers a little bit more here, and make sure that they're educated to have that option, whether or not they decide to wait post July 1. But if that maybe lights a fire for them, and they want a good mortgage rep, how do they get a hold of you?
Yeah, so you can get hold of me. Email or phone is works for me. So joe@mortgageconnection.ca, the email, and then phone's 403-617-9123.
Yeah, well, you've heard it from there. Well, I appreciate you taking a few minutes out of your day here and answering these questions here, because I think nobody wants to get stumped, especially when they have plans to move forward. But with that, I almost anticipate that the rental market may get a little bit stronger as a result of this.
Yeah, I mean, I think that is a reality that's going to happen, because even though I think the other insurers are hopefully going to say we're still comfortable, been in this long enough to know that they're going to be picky. So there is going to be less buyers probably in the market. So if you are out there buying, you're going to have a good opportunity. It's going to have an impact for sure when the biggest insurer says we're going to lend to less people. Even if the other two are willing to pick up some of that. So yeah, I think it's an opportunity for potentially investors as well. That you're probably in a market where the rental market is going to be stronger.
Yeah, I think that's it's good to see a silver lining where you can on it. So yeah, excellent. Thanks for the time, and enjoy the rest of the week.
You too, guys. Thanks so much.
Yeah.
Take care.
Cheers.
Bye.